This is the Build Wealth Canada podcast, episode number 30.
Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell from the Build Wealth Canada show. Today, we have a very special guest who has actually worked as an advisor for some of Canada's largest banks, really giving him some good insider information on how we can all save money when dealing with the banks. Now, his name is John Kalos, and he runs Merit Financial Planning, where he basically specializes in doing financial planning for business owners here in Canada. And he also has his own new podcast called Confessions of an Ex-Banker, where he also shares some of the secrets that he learned when working in the banking industry. Now, you can check out John and all of his details by going over to the show notes at buildwealthcanada.ca/30. So just the number 30. All right, now before we get into the interview, I wanted to let you know that I've been invited to speak at the Young Money webinar series hosted by Canadian Money Saver magazine. So I wanted to definitely invite you to that, as there's really some good speakers lined up, and I will be presenting actually this coming Thursday, so Thursday, October the 13th, on the subject of will you have enough to retire, where I'll basically look at the key factors to consider when determining whether you're on track to retire, no matter how old you are, and how to plan in such a way that helps ensure that you don't run out of money in your retirement. All right, so you can learn more and sign up for the webinar by going to buildwealthcanada.ca/webinar. Last but definitely not least, I wanted to give a shout out to our sponsor 5i Research, where you can sign up for free to see the recommendations on the top dividend stocks, the top growth stocks in Canada, as well as view their model portfolios and have access to their database of over 47,000 answered investing questions from across Canada. And since you're a Build Wealth Canada listener, you can get full access to all of this for free for 30 days by going to buildwealthcanada.ca/trial. All right. Now, alternatively, if you're more interested in being an index investor but aren't sure how to get started and how to do everything properly, you can check out my in-depth step-by-step video guide over at buildwealthcanada.ca/invest. All right. Now, all these links are in the show notes too over at buildwealthcanada.ca/30. So I really hope you check them out. And now let's get into the interview. All right, John, welcome to the show.
Thank you, Cornell. Nice to be here.
So really excited to talk to you. You've actually worked at some of the major banks, so you actually know the inner workings of everything. And I thought we could really pick your brain a bit to figure out sort of how we can get basically, the best rates at the banks, how we could save some money at the banks, how to basically help us negotiate a bit better, whether it's our, mortgage, line of credit, or bank fees, or especially investment products, as I know that's kind of a really big area where there's a lot of money to be saved. So, really to kick things off with the first question, let's say that we're saving money for something like education, a down payment on a house, a car, basically something where we want the money to stay relatively, pretty safe. We don't want it to be fluctuating, but at the same time, you don't just want to keep it in, let's say, a checking account where it's earning next to nothing, especially with where the interest rates are right now. So, when it comes to these really safe investments, what are the options that we have as Canadians, and how can we get the best rates?
Well, as far as investments are concerned, Cornell, when we say safety, that word is relative. Everybody has a different meaning when it comes to safety. Now, if I have a client or somebody ask me what's the best way to save if I'm going to need something a year or two from now, that's where I'd say you probably don't want to put your money in the markets, in any kind of instrument in the markets, because anything could happen over the short term. So at that point, I would suggest purchasing some guaranteed investment certificates, GICs. And the best place you'd be able to get those are actually online, what we call online banking right now, where you're probably going to end up getting up to 3/4 or 1% higher than what you can get when you walk into your branch. Now, the other question that people ask is, should I be saving this money outside my RSP, inside my RSP, or TFSA? There's these three options. And the way I always suggest to clients is, an RSP for me is sacred. I wouldn't touch the RRSP unless I had no other option. So other people will argue that, but I'd like to consider the RSP as truly the retirement vehicle and nothing else. But again, if that's the last resort, then you have no choice in going into your RSP. What I would suggest to save it would be in the TFSA, where you can save money in these registered accounts, but the interest or any kind of gains that you make are not taxable. So GICs from a third party or from an online bank inside a TFSA.
Okay, understood. So then when you let's say you look online, you do your searches, you find some good rates there, then you would, I assume, open up a TFSA account kind of with that institution, and then that's basically, and then you would buy the GICs, and then they would basically go into the TFSA at that institution, and then you could have another TFSA account, let's say in your discount brokerage or elsewhere at your branch, but that's where you would basically keep the GICs. Is that how you would structure it?
That is right. And you mentioned the discount brokerage. Through a discount brokerage, you could get higher rates than what you get at your bank when you walk into your branch. But it's worth looking around for other institutions as well. I believe in Canada there's like 80 different institutions that offer guaranteed investment certificates, and they all fall under the $100,000 CDIC protection. That's a protection fund where if any institution fails, you're guaranteed up to $100,000. Mm-hmm. So there are times where you're going to get promotions from different institutions. So I'd spend a little bit of time looking at the different choices that there are, and then comparing those with a discount brokerage as well, and you'll end up with the best rate.
Okay, and is there a certain resource you like to go to look up those rates, or is it just kind of you do a Google search and then generally they'll kind of come up near the top, and then you basically look at what the different providers are doing?
I always say ask Mr. Google.
Right, because it's always fluctuating anyway, and things change. So it makes sense.
Get 5 or 6 different opinions from different institutions, and then just pick your best rate. Just to mention also, as far as the TFSA is concerned, the limits are a little over $5,000 right now, but if you haven't contributed in previous years in your TFSA, you can actually add those contributions in as well. So you're not limited to only $5,000 if you haven't made contributions in the past. That's
right. Yeah, and you can always go on the CRI website, log into your account, and you can always check what those kind of limits are for you right now. That's a really good point, because someone might look at that and say, oh well, or they might kind of read that, oh, my limit is, I think it's $5,500 now or something. It's around there, right?
That's right.
Yeah, and so they might look at that and say, oh well, I'm saving for a car. That's nothing. But really, if you haven't been contributing to TFSA, you actually could have. I think at this point it's like well over. At the time of this recording, it's like well over $40,000 now. I think it's 45, if I'm not mistaken.
I believe it's 40.
Yeah. So it's quite a bit if you haven't been using your TFSA. So I mean, technically, I know I can definitely buy a car for a lot less than that.
That's right.
And it can take up a big chunk of your down payment for your mortgage too, if that was your intent instead.
Right. Now, when it comes, you mentioned also, RESP. When it comes to RESPs, again, depending on how much time you have before you need the money, if you have over 10 years before you'll need the money for your children's education, that's where I would consider going into different instruments other than GICs, and that would be, like blue chip stocks, in the Canadian markets, in the U.S. markets, in the European markets. I think you're likely to get a better return over the long term when it comes to investing using those instruments. I wouldn't necessarily put it all in the markets, but that'll depend on the tolerance that each investor has for the day-to-day or year-to-year fluctuations.
Yeah. And then how do you find that the GICs, how do they compare to some of those? Because there's some banks now where, they offer actually pretty high interest savings accounts. Like I know I'm with one right now where I keep my emergency fund, and they're actually getting me 2%, which, for an account is quite a bit, at the time of this recording, things may change. But so how do you find, GICs compared to some of those different banks? Are they a lot higher? Because it sounds like it's a lot more of a kind of a hassle, right, to get one.
That's right. And you know what? Real rates aren't much higher than that. Mm-hmm. And when you do go online and check for these banks, you make a good point. They do offer bank accounts as well. And generally speaking, the 1-year GIC, if you lock in your money for 1 year, it's pretty much the same as a bank account. Now, again, on a daily basis, these rates change depending on the bank's need for funds. So that'll change from one day to another. But if you're looking at a couple of years to save money, for example, then you might want to lock some of that money into a 2-year GIC where you're probably going to get a higher rate. Mm-hmm. So if I have, let's just say this, if I have $20,000 that I want to save and I'm going to use in 2 years, I'd put $10,000 in the bank account. I'd put $10,000 in the 2-year GIC.
Okay, that makes sense. Okay, yeah, that sounds good. And then you mentioned about how oftentimes you can get better rates if you just search online as opposed to going to your typical branch. Is that an area that you can generally negotiate with at the bank? So if you go to your local branch and say, look, I was online, I saw these rates at these providers. It'd be more convenient for me just to go with you since I already bank with you. Can you guys match this or beat it? How aggressive can you be, or do you, from your experience, will the bank just say, okay, well, no, these are our rates, and kind of take it or leave it?
I'll tell you what the banks do is they'll look at your overall assets, net worth, and see if they're able to get more business in the future.
Oh, okay.
So if it's a young couple that's starting out to look for a mortgage and they have some money to save, well, the bank is not going to be very favorable to meeting the rates that you find online. And that's for two reasons. One, you barely have any assets to begin with, so they're not going to make much money on you, with you. And now, when you're out there buying a mortgage, a couple of years from now, you're still not going to have a lot of assets. And mortgages these days, Cornell, have become a loss leader to try to bring other business from the competition of those clients.
Interesting.
Yeah, so they don't care too much about the mortgage. You can get great rates about the mortgage, and I'm sure we'll talk about that in a few moments. But basically, they want to lure you in with the mortgage so they can get the bank account, so they can get the, if you have any investments elsewhere. That's where they're making their money right now. So to answer your question, it's highly unlikely, especially when it comes to bank accounts, that you're going to get a rate that you're able to get with these online banks, okay? And GICs as well, I can tell you, if you're not going to be presenting more business or more potential for the bank, they're not going to look at it. They can't come close to the rates that are offered by these other institutions.
Interesting. That's really fascinating. Yeah. So, and it makes, from a kind of marketing sales sort of perspective, yeah, they're just looking at, okay, what is the lifetime value of this customer? And they kind of say, okay, well, yeah, if you've got $1 million in assets that you currently have at another institution, well, yeah, let's give you some good rates. Let's give you some good deals. We'll cut your fees or whatever.
That's correct.
But then the intent is to ultimately migrate all that money over to their institution so that now they can charge you those fees. So
exactly.
that's really interesting. Yeah. So because that was kind of my follow-up question is, when you're doing these negotiations with a bank, whether it's a mortgage or line of credit or investment products, anything really that they sell, how hard can you push? And it sounds like your answer is, well, you can always try to, push hard, but if you don't have a lot of sort of investable assets or things, then they're going to see you kind of as a small fish, and they'll just say it's not worth our time. Basically.
That's correct, basically. And it wouldn't be worth their time unless, as you mentioned, you're able to show high potential for earnings in the future. And the banker that you're going to meet is going to take your case and take it to the manager. The manager might take it to the regional manager, but if, they have to see some sort of potential profit coming in the future.
Interesting. Okay. Yeah. So that was kind of my sort of next line of questions was, let's go over some of these different products that the banks offer, and how hard can you push on these different ones, and how can you maximize your chances of basically saving money, getting the best rates. So I think we've kind of covered that already a fair bit. So you're saying with mortgages, you're saying on that one, you can actually push pretty hard because they're kind of, whether you have a lot of assets or not, it sounds like that's, like you said, it's a loss leader. So they're not expecting to make a lot. And that's kind of where, I guess where you can save quite a bit of money if you get a bit aggressive.
Yeah, that's right. And I'm going to give you a couple of tips that nobody knows unless they've worked in banks before. And this is where you can squeeze a little bit more out of them is, first of all, arm yourself with the best rates in the industry. And that, again, is coming from other lenders that exist out there. As I mentioned earlier, there are 80 different institutions that offer GICs or bank accounts or mortgages. Canadian Tire, for crying out loud, offers mortgages now. They've been doing that for a while. Now, arm yourself with the best rate. That's number one. Number two, when you're sitting down with your banker, tell them that you're going to buy their insurance. When they hear that, they'll do anything to get you as a client, because the insurance product itself is the biggest moneymaker for the bank. So bankers are shown ways to sort of lure clients into taking the insurance that comes when you're taking a mortgage through the bank. So I would say tell them that you're going to take the insurance, and then you have up to 30 days to change your mind. Now, why am I saying change your mind? People say it's not a bad idea to buy insurance. Well, if you buy an insurance policy on your mortgage, but if you buy it from a third party, an individual or an independent insurance company, for example, the insurance comes out to much less than you would have paid if you bought it through the bank. So tell the bank you're going to buy their insurance, but then 15 days later cancel it online, for example. That way you know you're going to get the best rate, and your banker's going to be happy. And then if you don't want to keep the insurance, you don't. But I would suggest, taking insurance, but taking it from an insurance agency.
Interesting. Oh, so you're saying basically you sign up with the mortgage, the home closes, right? And then after that happens, let's say 15 days after the actual mortgage signing, or within the 15 days, you go online and you cancel that.
That's right. That's right.
And you make sure you read the fine print so that you know that you're within your right to cancel it and that there are no crazy penalties or whatever.
Exactly.
Obviously, you have to do your due diligence and read the fine print. But that's interesting. Yeah.
Or you can go online. You can go online on their online banking or telephone banking and ask them how much time do I have before I cancel it, how much time do I have to cancel it. And if they tell you 30 days or 15 days or whatever, you can take that to the bank, let's say.
Oh, okay. Interesting. So you should definitely kind of do that research kind of ahead of time just to make sure. Because there's a lot of fine print in those documents.
Exactly. It's unreal.
Yeah.
It's unreal.
Yeah. So you have to be very, very thorough. But I guess, that could give you some negotiating power. Yeah, I know what I used to do is when we had our older mortgage, that's kind of what I did as well. Well, not with the insurance, but I would basically, get kind of the best rates in the industry with the online research. And then I would basically kind of take him to the mortgage broker that we were considering. And I said, okay, look, this is what kind of I can get right now. So Are you able to beat this? I mean, I know. And at that point, so the mortgage we ended up actually being through a major bank, which kind of, people will typically say, oh, well, they have higher rates and stuff. Well, yeah, but when you walk down the street and you see the branch and you see the posters on their windows, right? It's like it's a really high rate you see there, but you can negotiate that down quite a bit. And I remember that's what I did. So that kind of, I think, to supplement your point that, with mortgages, you can actually negotiate quite heavily, just come armed with a lot of information.
Exactly.
And they're able to move on that quite a bit. They definitely did for us. Like for us, it was to the point where we'd rather, at that point, it was better to go with the bigger bank because we're getting the same rate as kind of the smaller, less established bank, and the terms were better in terms of the prepayment privileges. So, lots of, at least from my own experience, there's a lot of negotiating room. So it's interesting. I'm glad you kind of said that's what you've seen on your end as well, being in the business.
That's correct. And I'll give you one more tool. If you have, let's say, investments at another institution, you can tell the institution that you're sort of courting, you can tell them that I'll give the financial planner a chance to bid for my business, my investments. They hear that, and they'll roll out the red carpet. So tell them, I want to see your financial planner after we close the mortgage. I want to see your financial planner so you can evaluate my investments that I have at this other bank.
Very interesting. Yeah, so you could say, okay, I've got this much in assets invested currently, here or here or here, and I'm considering potentially switching it just so that it's all in one location, for example, so I can have my bank and my mortgage and my investments with you.
Exactly.
I'm considering that, but you've got to help me out here on this mortgage kind of thing.
Exactly.
And then that's interesting. Wow.
Those are the insider tricks.
Interesting. But everyone, remember, always read kind of the fine print, do your due diligence ahead of time, because you have to be very careful with stuff. But yeah, for sure. I mean, if like you said, if they see you as a big potential client and you're willing to, let's say, listen to their advisor or whatever for a bit, and then it could save you a lot of money. Interesting. Okay, yeah, that's really interesting. So I guess that's the case with mortgages, with lines of credit. It sounds like that's a similar kind of scenario. And then, with bank fees, what's kind of been your experience with that? I'm guessing you're able to negotiate those kind of in the same way, right? If you're seen as a potentially high worth client, they're willing to cut those as well.
I'll tell you what I don't have too much experience with bank fees because I was never a banker per se. I was a financial planner, so I never had an opportunity to negotiate fees or anything like that. But what I can tell you is, when it comes to bank accounts, they'll give you the best plan that they have, and they'll go through a questionnaire that will ask you how many transactions do you make a month, or a bunch of other questions that'll give them an idea what the best banking plan is available for you. There's not a lot of room to negotiate banking fees. It's pretty much, I shouldn't say set in stone, but rarely have I seen the bank waive fees because you're going to take a mortgage from them in a couple of years or something like that. I think the best way to do that, and again, things change on a regular basis, is, look at different institutions, and they have online calculators that will show you what your banking fees are. Now, you might save a nickel or a dime here or a dollar or two a month, but you got to remember also, for your convenience, you don't want to be spread out to too many different institutions, because the paperwork that you'll be getting will be crazy. So it might be worth, foregoing a couple of dollars a month of savings to keep your bank account with the firm that you're taking a mortgage with, or that you're investing with.
Yeah, and that makes a lot of sense, because they have their system set up in a certain way to offer these different sort of banking plans, right? These different packages. So to change it for one person while signing them up, I mean, that would create a lot of administrative work, and it kind of, I could see that being kind of not great in a system, right? It's easier to just to say, okay, they pick this plan, they pick that plan.
Exactly,
right?
exactly.
So that makes total sense, kind of from an implementation standpoint. But
what I can tell you, at least for the Bank of Montreal, you can definitely ask for a lot of air mile points, and they'll give it.
Nice. Yeah. So it sounds like there's certain things you can negotiate where they have, they can just kind of override the system or whatever.
That's right.
Yeah, that makes sense. And yeah, I know too. I mean, maybe there's less flexibility on the bank fees, but if you do get charged a fee, and if you were in very good standing with the bank, like let's say with a credit card where you've always paid it on time, you've always paid it in full every month, or at least the minimum, that kind of thing. If you're a good customer and you've been with them for years, they are definitely, and I mean, I've seen this happen where they will very easily waive some of these fees for you, because let's say you forgot to pay on time one month, for example.
Yeah, right.
Like things like that. If you're a good client, they're not going to risk losing you as a customer because one month you slipped up when for the past 5 years you've been great. So
absolutely.
Yeah. So that's kind of that happened to I've seen that recently, actually, and like I had to go through that, and it was very I was surprised how nice they were. because they know you've got a really good history, so they're like, okay, if this happens once every decade, you're like, okay, we're not gonna ruffle this guy's feathers because we want to keep him as a customer. Right. So,
and I can tell you, I have absolutely zero experience when it comes to bank fees, because for over 20 years I was working for banks for two banks. Yeah. So I never paid fees. This is all brand new to me. Over the past year I started paying fees. This is brand new, and it pisses me off, to be honest with you.
Yeah.
But anyhow.
No, I get it. Yeah. We like for my personal banking, I use the free accounts, the free banks, right? And I always wondered why are people still paying for fees? Yeah. I know if you own a business it's a bit different, because there's certain things you need from them, and then you pay some fees, which kind of frustrates me as well. But but if you're just a regular person, then yeah, definitely consider not paying bank fees, because there's some good banks out there where they don't put limits on withdrawals and things like that, or limits on how many times you can withdraw and things like that.
Exactly.
Okay, no, that's awesome. Yeah, so no, thanks for that. That's it's really interesting to get your insight on that. And then the other thing I wanted to mention this, and we've talked about this a bit on the podcast before. So you mentioned in your podcast, you have one as well, where basically there's a potential conflict of interest between the banker and advisor and their clients. So based on your experience at these banks, you've kind of firsthand experienced this potential conflict of interest. Can you elaborate on this and maybe give us a few examples of where you actually saw this happen?
Right. Now, this is an area that's very dear to me, because I'm a financial planner. I've been involved in investments for over 20 years. And there is an inherent conflict of interest, and it's quite easy to understand. Bankers / advisors / brokers, or what have you, many terms that people use, are paid, I'll say 95% of bankers and advisors are paid based on the products that they sell. And some products pay a lot more than other products. That's one reason why there's a conflict of interest, or a potential conflict of interest. Reason number two is they have objectives as to what products or how much they need to sell for each product. So I can be a banker sitting in a bank, or a financial planner. Again, and this is mostly, or I'd say pretty much all of the advisors that work for banks, or in the investment firms that are owned by the banks. So they have objectives, and if you are at 70% of your objectives in mutual funds, and if you're at 150% of your objectives in GICs, and your boss is breathing down your neck telling you got to pick up some more mutual funds, well, there's a chance that when you walk into the branch, mutual funds will be pushed on you. And I've seen conversations with clients change in a matter of 1 month, because the advisor, reached their objectives and now it's time to sell GICs. So I'm not saying everybody does that, but there's a potential for that. When your advisor is selling mutual funds, there's lots of information about the mutual funds that is not told to clients. And one of the biggest information when it comes to this is the fees that they pay for mutual funds. So we're talking, the average balanced fund or equity fund in Canada is about 2.5%, and that's jailhouse robbery as far as I'm concerned. Now those fees, those annual fees, part of that goes to pay the investment advisor that's selling the actual product. So the bottom line is, when anyone is paid based on the product that they sell, there's always potential for conflict of interest.
Right. Yeah. And I mean, that's kind of a similar approach to if you go to a car dealership, right? There's a good chance that salesperson is paid they get more money if they sell you like a Ferrari versus like a low end Ford, for example, not this, like a lower end model. So obviously, obviously there's more to it, right? They have to find the right fit and your budget and all that. But yeah, when you're paid more to sell more, you're likely to recommend things that make you more money. Not saying like, and I'm sure there's a lot of really ethical, good people in the industry too.
Absolutely.
But like you said, there is that chance that you might get someone that where, yeah, like you said, over the span of a month, their view all of a sudden changes as to what you should invest in. And that's only because they're worried that their boss is going to, fire them or not promote them or something, right? So
exactly. And
yeah.
I've always said, never blame the banker or the advisor for this.
Right.
It's the bank that's pushing them so much. When I was in the banks, I remember the regional manager calling up the branches on a daily basis and asking them how much mutual funds they've sold when they were really behind in their objectives. And they had 3 more months, for example, to get those numbers up. There would be pressure, and I'm saying hard pressure, to sell mutual funds. And that's unfortunate. When I first started out in the industry, and I'd say up until maybe 10 years ago, I had an objective to bring in funds to the institution that I was working at. But it didn't matter whether it went to GICs or mutual funds, or if I referred the client to a partner of the bank, like a brokerage firm or the private bank, for example. There wasn't any added incentive to sell a certain product. We were just told, bring in assets, put them where you want, or what's best for the client. That's not the case today. Mm-hmm. And that's very unfortunate.
Yeah. Yeah, that's interesting. Yeah, and yeah, for sure. We're not saying everyone's like that works at the banks, but like you said, the way the system, I guess, the structure, right? The way everyone, if you have to hit your sales targets, things like that, right? And
right.
It's not, I guess, structured in such a way where you and I, if we're just regular Canadians looking to invest, where it benefits us, right? It's not
right. And you know what? It leaves room for that type of behavior.
Right.
Now here's another one that's really a strong point. I'm a big fan of what's called ETFs, exchange traded funds. Okay, and just very quickly, I'll tell you. I'm sure you know, but for the listeners, it's pretty much a basket of investments, much like mutual funds, except that the fees that you're paying on an annual basis are almost negligible. You're able to get an ETF in Canada, exchange traded fund again, in Canada, that invests in the Toronto Stock Exchange for 0.05%. That's 5 basis points versus the average equity fund that banks offer at over 2%. Mm-hmm. That's huge.
Yeah, I own a lot of those. I buy those every month. And
that's all I use. That's all I use, and that's all I recommend for my clients as well. But again, you're not going to get that advice from advisors because they don't get paid for selling these products. Mm-hmm. I mean, there's been some companies that offer ETFs that are starting to compensate brokers because they have no choice. Yeah. People are really finding out. But generally speaking, your broker or your advisor or your banker will never tell you about exchange traded funds because they're not paid to sell it.
Mm-hmm, mm-hmm. Yeah.
We go back to the what you're paid on what you sell.
Mm-hmm. That's right. Yeah, that was one of my questions. Is what do you recommend to your clients, because you're an advisor, but you don't have that conflict, right? You're not trying to sell a particular mutual fund or anything like that, right?
Exactly. I get paid by the client to consult them and to do a financial plan for them and to review their plan and so on and so forth. Now, you see, I'm remembering another point when it comes to financial planning. The most important aspect of financial planning is to do at least one or twice a year an annual review or a semi-annual review to make sure everything is still going right. You may need to change certain investments to others depending on what's happening in the markets. The bottom line is you have to review and rebalance. That's rarely done in the banks, again, because there's no incentive for them to do that. Mm-hmm. Once they bring in your money, there's very little money to go get after that. So you're basically going to get a call once a year for your RSP contributions, and that's it. Again, this goes back to, you get paid on products that you sell, not on service or advice that you give.
Okay, right. So you have a financial incentive to basically just sell more, not necessarily spend that extra half an hour or hour with a client, because maybe their situation changed a bit. Maybe they had a kid or something, right? And now it's okay, things are different now, let's restructure. So I see what you're saying. There's less of an incentive to help them. Mm-hmm.
Or maybe if the markets go up substantially, and if your original profile was to be a 50-50 investor, 50% markets and 50% safety, if markets go up substantially, well, then all of a sudden your portfolio is more has a higher percentage to equities. Right. And at that point, the best thing you can do is sell some of that to bring it back to 50-50. And that just, the old adage is sell high and buy low. So you'd be selling a little bit just so you can rebalance your portfolio. And those are strategies, again, that are rarely done in institutions like that. Interesting.
And then are there any other sort of, because this is kind of an interesting question too, I think, since you've been in the industry for so long, can you elaborate a bit as well on kind of the difference between what a financial planner does at the bank versus someone like yourself, like a fee-for-service or fee-based financial planner?
Right. I'll tell you, a financial planner at a bank, when you're a financial planner, you have the abilities to do what I like to call total wealth management, which is an investment plan, a retirement plan. You do estate planning for the client. You help them write their will, or at least you assist them with, you'll go
with the lawyer
with the lawyer or the notary to write their will. So this is what I call total wealth management, insurance planning. A financial planner who's been trained properly can more than scratch the surface on these topics. Okay, and now that's what you get. That's what you should be getting when you're dealing with a fee-based financial planner. That's what you should get when you're dealing with any kind of financial planner. But in the banks, again, there is no incentive for them to do anything else but an investment plan or a retirement plan. So people the majority of Canadians believe that a financial plan is a retirement plan, which is not the case. That's only one spoke of right. 5 or 6 other different areas that you should be covering. So a planner in a bank, again, will only do retirement or investment planning for you. There's no incentive for them to do anything else because they tried to lure you to buy into products using an investment plan or a retirement plan. Mm-hmm, mm-hmm. So that's what a financial planner does, a certified financial planner at a bank. A banker, which is, the person that you meet, to do your mortgage or to do a bank account or what have you, they probably have a mutual fund license and they can just sell you mutual funds. They can't do comprehensive financial planning or retirement planning. So usually when an individual or a client walks into a bank and they have investment needs and their needs are, the amount of money that they have is, let's say, over $20 or $30 or $50,000, they'll usually get referred to a financial planner of that branch. Mm-hmm. And they'd be able to help you out a little bit more. But again, all you're getting is a retirement plan or an investment plan.
Right. Yeah, so I think kind of the big takeaway here for the listeners is just to never assume that because you have a retirement plan that's the whole story and you're basically set and you don't have to worry about all these other things. So there are these other parts of sort of financial planning that's more than just kind of investments, right? And
absolutely.
So it's important to kind of look at the entire picture, right? Because if you're just focused on investments, fine, but let's say you're getting older, you don't have an estate plan, that could really hurt you if you don't have that. So that could be, you can kind of shoot yourself in the foot a little bit there if you kind of go on thinking you're fully covered when really you don't even have any sort of estate planning in place, even though you're maybe much older. So yeah, I'm glad you brought that up. I think that's a really good kind of warning sign. Yeah.
And I'll tell you one more point, which is extremely important: tax planning. It's amazing how many people are not using all the tax strategies that are out there to either reduce or defer their taxes. And I see that quite a bit with business owners, because business owners have a lot more tax advantages than a typical employee, let's say. But even the employee is not using all the strategies that are out there. So a financial planner, a good financial planner, will look at, are there any other ways that you can reduce income or reduce income taxes? Is there any way that you can split your income? There's strategies out there that people don't use that are available, and that's another huge part of a financial plan.
Yeah. No, that's great. So, you mentioned ETFs, and are there any other sort of top ways that you recommend that you can save money on your investments?
Look, again, the typical Canadian is buying either GICs or mutual funds. So the best way to, I would not use mutual funds. The only time I would use mutual funds would be if there's an individual who's just starting to make money and they want to save $50 or $100 a month. Your only choice is mutual funds, okay? But when you reach a certain level of assets, I would say, as little as 15, 20,000 or more, that's when I'd start using exchange traded funds. But again, the problem with that is you're not going to get that from your banker or your financial advisor. You're either going to do it on your own, or you're going to seek out an independent financial planner that uses exchange traded funds. So, and as far as GICs are concerned, let's go back to the beginning of the show where, we said, try to find GICs at other institutions that'll give you a better rate than what banks are offering you. Now, if you want to invest in individual stocks, that's a different story. And I would say for the majority of Canadians, trying to stock pick or trying to create a portfolio of stocks is quite difficult, if not impossible, if you're not following the markets all the time. And even if you do follow the markets all the time, it's been proven time and time again that nobody can outperform the markets themselves. So you can buy the entire market using exchange traded funds or ETFs.
Yeah, and I mean that's what I've been doing for quite a while now, just buying ETFs, and I mean that's like after researching this sort of extensively, very extensively, that's kind of that seems to be over and over and over again, that it keeps coming up, that's kind of the sort of the at least for me personally, that's a really good that's a really good fit, because I'm very kind of fee conscious and I don't mind doing it myself. I will say, because technically if you really don't want to do it yourself, even though I would argue it's actually pretty easy through a discount brokerage. I mean if you have only a couple $100, let's say, or $100 a month to invest, I mean you could still go to a discount brokerage account, and you could there is one, for example, that I use where you can actually buy the ETFs for free. So you could actually still start with very small amounts of money. Actually, I think you need like $1,000 or something like that to open one up. But so there are some options if you're just getting started, just to kind of work your way into it.
That's awesome. I wasn't aware of that.
Yeah, it's very that's kind of, because a lot of times sometimes people will say, oh well, yeah, you go to a discount brokerage, do it yourself once your assets are big enough, right? Because the kind of the big thing that they say as well, it's because of the trading fees, because you're gonna have to pay, let's say, $10 every time you trade. So if you're buying 4 ETFs every month, let's say that's $40. So that really adds up over time, right?
That's right. When you're first starting off. That's
right. So if you're just buying like 2 ETFs, I mean, that's not worth paying, like $20 in fees. Like it's
exactly.
Like it becomes it doesn't make any sense. So I see what you're saying there, but I know like with what I use is like you can actually buy them for free. And so when you do that, then it's good, because you're basically practicing buying ETFs yourself with small amounts of money. So it's kind of a nice way to get your feet wet and you get comfortable with the process. And then as your salary goes up, as you're saving more, you can put more and more in. And at that point you feel comfortable, right?
That's great. And I'm glad we're talking, because I wasn't aware of that.
Yeah,
that there's institutions out there that sell them for free. That's awesome.
Yeah. So that's kind of like, so that's kind of the, that's something that's worth they don't make much money off it. In fact, I actually talked to them and I said, because I was trying to, I was actually chatting with them, and they said, look, like when it comes to, because I told them, listeners of the show, a lot of the listeners of this show, they do buy ETFs, right? And and they're saying, we don't make like barely not much money of that at all as a discount broker, because
you make nothing.
Like they're like, it's not worth that. So they won't, they occasionally they won't promote it very, that they would rather promote other things, right? They'd rather promote active traders, right? Where you're stock picking, because then you're buying and selling all the time, and they get a commission each time, right? So
that's right.
That's kind of almost like a little secret, although like with shows like this and others, it's becoming less of a secret that actually ETFs are out there. It is much cheaper, and it is possible to do it yourself. But
yes, but you'd be surprised at how, at least people that walk into banks, and I've been in the banking industry for over 20 years, there's not a lot of people that know about these things. It might be easy for you and I. We're in the industry. We're looking at these things all the time, but that's not the case with, I'd say, the majority of Canadians. And they're still not aware of these tools. And what I can say about ETFs is I've been clipping articles, and before they were called ETFs, they used to be called index funds, or something in Canada used to be called drips or spiders in the US, that you can buy. I was clipping articles before the internet in the 90s that was showing how ETFs, or at least the markets themselves, outperform money managers, and the biggest reason is fees. So if you're saving 2% a year on fees, like when I run numbers for clients and I show them, let's say you have $100,000 and you're saving $2,000 in fees. Well, over 20 years, if your money is growing at 6%, which is a decent rate to use,
right,
the fees are about $100,000. That's over 20 years. That you wiped out your initial investment by fees over 20 years. It's unreal when I run these numbers. I have to run them again because sometimes I'm shaking my head. It's unbelievable.
It's funny you mention that, because the exact same thing happened to me. So I the first time I heard that you could save like a 6-figure sum, right? Like over $100,000. I thought that doesn't sound right. That's too much. That can't be right. Like, there's the markets are competitive. There's no way that, there can be that much of a difference. So I was so skeptical, but it's coming from, reputable sources. So I'm kind of, okay, you know what? Just so it doesn't bug me anymore, I'm going to just calculate the numbers myself and see, like what it would be for myself. And it was actually like hundreds of thousands. So like not more, like multiple sets of 100,000 over my lifetime. So, after that I was sold. I thought, this is insane. How can anyone do that? But yeah, I guess there's like, the people don't really know, like you said, right? And so,
and they're not promoted. I was reading an article a couple of weeks ago. It was from a reputable website here in Canada that mentioned that the headline was "Ask not, say not" when it comes to ETFs. As far as the brokerage community or the investment community, they don't talk about it unless they're asked about it. They don't bring it up, and that's been hurting their sales. It also hurts Canadians. Let's face it.
Yeah, it's interesting.
And Warren Buffett himself, and I have this article too that I like showing people, told his family when he passes away, put all his money in index funds, which are the equivalent of exchange traded funds.
That's right. Yeah.
If it's good for him, damn right it's going to be good for me.
Yeah, for sure. And I think I mentioned that like in an article where they talked about that in a previous episode, actually. Yeah, it's kind of, you might not agree with everything, he does or says, but, when he's recommending to his own family what to do, who aren't all, professional stock investors,
right.
It's interesting how he's also saying, just go broad, don't, basically he's kind of saying, don't do what I do unless you're willing to do it, full time and become like a true, professional at it, essentially.
Right. And he is a big fan of ETFs, and he uses ETFs as well. Now, we bring up Warren Buffett. A lot of people don't know, but you can do exactly what Warren Buffett does by buying a certain share in the market, which replicates his portfolio. Mm-hmm. But you'll never hear that again from advisors because, again, they're not paid for that. Mm-hmm, mm-hmm. Yeah. They'll get paid for buying the stock once, and the client will keep it forever, and then they're not making any more commission.
Mm-hmm. Are you saying, so you're referring to owning basically, so there's like an ETF that owns what Berkshire Hathaway owns? Is that what you're saying?
No, just buying Berkshire Hathaway share.
Oh, okay, gotcha. Okay, yep.
Yeah, that's right. And in the old days, the shares used to be worth like $100,000 or $150,000. Now they've developed another share, which I believe is in the hundreds of dollars. So it's accessible. His strategy of investing is accessible to everyone right now.
Yeah. For sure. Yeah, no, I'm definitely, we're definitely kind of on the same, we're both kind of believers of the ETF, it sounds like, for sure. Now, when you recommend the ETFs, are you also big into recommending that you basically go broad, so buy the entire US market, the entire Canadian, or are you one of those guys that say, no, let's niche it down, let's focus on specific ETFs within different sectors, things like that? What's your stance on that?
You know something, Cornell? I'm a true believer of keeping things simple. So I'm not going to say let's buy 10% of this junior gold ETF and 10% of the oil ETF. When you're buying the Canadian market as a whole, so you're able to buy the TSX, the TSX 50, for example, you're buying 50 of the biggest and the best companies in Canada. To me, that's enough for the average investor, unless the client really wants to get technical. I don't think it's worth it. Yeah. In my career, I haven't seen people doing a heck of a lot better. Really, buying 5 or 6 or 7 different ETFs. Actually, I shouldn't say 5 or 6. I like to stick with the broad Canadian markets, a dividend fund in Canada, for example, blue chips in Europe, a little bit of the Far East. I don't get terribly complicated.
Yeah, I keep things pretty simple. I keep things pretty simple as well. And from all the research that I've read, it basically points that, if you get fancier and if you really know what you're doing and you devote a lot of time into it, you may be able to squeeze maybe a little bit return if you're, if you do things correctly, that, which is kind of a big if, right? No, whereas you can keep it simple and not really have to worry about that if. But they said that even if you do all these tweaks and you're able to squeeze out a little bit more return because, you're kind of nitpicking and you're getting more specific, then that actually is the amount you gain from doing that is nothing compared to how much you're saving in fees. So basically, fees totally overshadow that extra little bit of gain that you might get if you actually do things, properly in a more complicated fashion. So
absolutely.
So it's almost like before you even if you think, because I get questions like this sometimes from listeners of the show where they're like, well, I'm thinking of, I tell everyone that I just do a really simple kind of straightforward portfolio. I do basically, a third in Canada, in terms of equity, I do third in Canada, third of US, third international, and I have some emerging markets in there, and I get some questions sometimes of Canadians saying, okay, well, I wanted to do, let's say there's different portfolios out there, right? Like what if I put this much in gold and this much in there and this much in there? And I just kind of say, well, look, from the research I've seen, and I refer them to, some research I've read. Yeah. If you do things the other, like the more complicated way, you might be able to squeeze a bit more if you don't mess it up. Based on history, which isn't even all that, you can guarantee, the future based on history anyway. But if you're focused on that and you're still paying a lot in fees, then why don't focus on the fees first? Is basically what I'm saying. That's the low hanging fruit.
Exactly. And what I can tell you of other studies that I'm sure you've heard of, your return, the overall return that you will be getting in the future doesn't depend on the actual investment itself. It depends on your asset allocation, which means if I'm relatively conservative and my portfolio is going to be 50% in the stock markets and 50% in safety, the actual investments that you choose are not the biggest indicators of what your rate is going to be. It's the actual asset allocation to make sure that it stays at 50-50. So all this trying to say that the biggest, the most important aspect of creating a portfolio is to figure out which asset allocation is best suited for yourself. And you can do that by sitting down with a financial planner and they'll, figure out what your tolerance for risk is. I like to show clients, when I show clients a portfolio of whatever, 70% equity, 30% safety, I like to show them what the worst case scenario for such a portfolio has been in any one given year.
Right.
And if it was like in 2008, it was like minus 20%. But then I showed them minus 20% was the fluctuation over 1 year. Over 5 years, it wasn't such a big fluctuation. But can you live with the idea that there's potential that your $1 million will go down to 800,000 over 1 year?
Right.
That's what really brings it out front to the client to say, yeah, I'd lose sleep. Let's go more conservative. Or, yeah, I got no problem with that because I know over 3 years or 5 years or more, such a portfolio has rarely had a negative return. But it show all the facts to clients so they know exactly what they're getting themselves into. So it's asset allocation, which is the most important aspect.
For sure. And being able to kind of stick with it and not switch or not say, okay, you put too much into equities, it went down, and now you basically sell everything off and you spread off the stock market. And then you basically just sold when everything was low.
Exactly.
And now you've just destroyed your plan there. So yeah, no, I've seen quite a bit of studies there as well where people get kind of very detailed about, okay, should I put some in gold? Should I put some in, these commodities here, things like that. But really it's more about asset allocation. Can you stick with it? Can you ride out the storms? I mean, are you minimizing your fees? I mean, those are the biggest levers, right?
That's right.
Yeah.
Make sure you're rebalancing your portfolio to get to your original asset allocation. That's the most important step as far as I'm concerned.
Yeah.
And that's where a good financial planner will proactively contact the client and say, let's look at your portfolio. We need to rebalance because, the markets have been terrible. And now all of a sudden you find yourself with too much safety. So let's buy some markets, buy when they're low.
Right. Exactly. Well, so I have to, I guess, we it looks like we're not going to have some crazy debate here, John, because it seems like we're pretty aligned. So on the one end, hopefully listeners are still finding this interesting, even though we're both kind of on board, with the same approach. But on the upside, so no drama on this episode, but
Cornell, I can give you an argument if you want.
but you know what? But at the same time, on the flip side, I'm happy that because you've been doing this for is it like 25 years? You said it's been a while. You've been doing this, right?
Since 1992.
Yeah, so you've been at this for quite a while. I've researched this to death before starting to invest as well. And I can obviously continue to do that as well. So it's always nice to see that. Okay, you know what? Even though we might not have some heated debate, it's nice to see that based on your years and years of experience and based on kind of all the research I've done too, that we're both kind of coming to the same conclusion. So at least that makes me sleep better at night with my investments. So that's good. Because but it's interesting, right? Because as you talk to more and more people, who really focused on educating themselves about this, you see kind of these things come up over and over again. That actually there seems to be quite a bit of consensus in terms of what to invest in and how to invest and the best practices. There seems to be a lot of that. Yeah,
that's right.
Very neat. Okay, go ahead.
I know. I was going to say, I think what your audience can take out of this, if we're going to wrap up in a minute or two, is first of all, try to find someone who is not paid based on the products that they sell. Mm-hmm. Okay, and you can do that. You can Google that information, and you can probably find out some financial planners in your area that are not paid based on commission. Two, if you really need a bank, meaning if you're not at the level where you have enough assets to go to a financial planner, when you visit the bank, tell them how can you invest in exchange traded funds, and hopefully they'll find somebody who can help you with that. Mm-hmm. Number three, when it comes to your mortgage, as we mentioned, which is something that many people think of these days, there's ways to negotiate. Bring in the rates that you find online. Tell them that you're going to buy insurance. Tell them that you're going to have your investments reviewed by their planner, and that's the way you're going to get the best rates.
Mm-hmm. Awesome. No, that's great. No, thank you for summarizing that. And you know what? Just to give you a little bit chance to talk about kind of what you do in your practice as well. I know you focus a lot on doing financial planning for business owners, which is pretty interesting because I know there's additional things that you can do if you actually own a business, right? When it comes to financial planning, taxation, things of that nature. So maybe now's a good chance for you to talk a little bit about kind of what you do and what are some of these sort of opportunities that business owners have just because they have a business, so they kind of have more flexibility. And are these is the payoff significant enough for people with businesses to even care about this?
Right. So my practice is exclusively business owners. And the reason I chose to do that is because, again, being in the banking sector for so many years, I noticed how underserved business owners were when it came to their finances, when it came to their taxes. And I decided to choose that because, first of all, I enjoy working with business owners. It's amazing how diversified businesses are. I still meet business owners and they tell me what they do, and I'm always saying, how in the world did you get into that? It's really something to see the entrepreneurial spirit in people. But as you mentioned, there's a lot more tax planning strategies that are available for business owners. And there's ways to split your income. In other words, try to give some income from your business to family members. There's other strategies that can replace an RRSP, where you'd be able to get maybe double the amount of reduction or tax return than you'd get through RSPs. There's insurance strategies, and it's not necessarily because you need life insurance to protect something. There are insurance strategies for business owners that help you defer taxes, and when you do eventually pass away, lots of money is going to come to is going to go to your family in a tax-free basis. So there's many different strategies that are available for business owners, and I can tell you, I'd say maybe 80% of business owners that I work with weren't using all the strategies that were available to them. And you'd think, with accountants, they'd be keeping their eyes on that. But it's amazing when I ask business owners, how their accountant is, the answer is they're okay, but, and the but is usually they're not proactive in looking at different solutions or different strategies that may, help the business owner. So I've always told clients it's better to have at least two pairs of eyes looking at your situation, where I could be debating their accountant and they can be answering me back, but we're coming up with different ideas that weren't thought of before. It's incredible, some fundamental things that accountants miss when they're dealing with their clients. And sometimes it's just a good idea to have a fresh pair of eyes that knows about tax planning strategies for business owners, for example. And that's where I think I'm able to stand out, because I have quite a bit of experience with tax planning for business owners. I've taken some extra courses and what have you, and I've had the long-term experience where I might be able to see something that their accountant hasn't seen or their tax professional hasn't seen.
Mm-hmm. Yeah, no, that's a great point. And I mean, when you have your own business, the stakes are pretty high. I mean, there's all these things that you can do, and I know, because I'm kind of in that world as well, and for sure I can see how because the dollars are so high in that, it makes sense to have a second set of eyes, because maybe your existing account specializes kind of more so in one area, and maybe there's some other strategies he doesn't know about, just because he's really good, in helping you in certain parts of your business, but maybe there's some parts that he, just hasn't devoted that time. And so that's where, you can have, an actual financial planner also take a look at it. Like you said, fresh pair of eyes, different types of kind of analysis maybe. And yeah, it's kind of to make sure you're kind of really maximizing it. Cause I mean, this isn't like, saving $100. Right? I mean, this is something where you can drastically affect, at the very least, what you're getting taxed if it's done properly, right? So
that's correct.
Yeah.
Well, I like doing a cost benefit analysis. So if there's a strategy that I'm recommending that might involve creating a new trust, for example, so creating another entity,
right?
Well, let's figure out how much this is going to cost us and how much it's going to save us every year, and then you're able to say it's going to cost you $5,000, but you're going to save $10,000 in taxes, for example. Business owners get surprised when I tell them you shouldn't be contributing into your RSP. And they're like, what? Like, nobody's told them that. And a good amount of business owners should not be contributing into their RRSPs. And they're always, completely surprised when I tell them that. They've never heard that from their bank, because, again, I mean, banks sell RRSPs.
Right.
They haven't heard it from their accountants because, again, they just don't know everything.
They specialize in different areas, basically, right? So that's fair. That's fair. Yeah, you can't.
And that's fine. They can't know everything.
Yeah.
So again, the more professionals look at your situation, the more ideas can flow.
That's awesome. So yeah, John, that's great. And I'm glad you mentioned that. You've got me intrigued about this, especially that RRSP comment. That's one I didn't know about for business owners. So that, so that's interesting. But yeah, how can
Cornell, ask Mr. Google. You're gonna get no, but you're gonna see, and if you'd like, I can explain to you, off the air. But
Sure.
it's something worth looking into. That's for sure.
That's interesting. Yeah, just because I know my dad has his own business, and I know he's putting some in the RRSP. Like he has his own corporation, right? So I'm sure he can kind of benefit from that. So I'm kind of thinking of him here, especially. But yeah, no, that's awesome. So no, thanks for that. And yeah, just maybe let everyone know how they can get in touch with you. I mean, I'll have on the show notes, I'll have a link to your site. We'll kind of have everything posted there too. But just in case someone's driving and can't check right now, maybe just tell us how we can reach you.
Well, my phone is very simple. My number is 514-819-3370. And check us out. My firm is called Merit Financial Planning. That's MERIT financialplanning.ca. And you can find me on LinkedIn, on Facebook, on Twitter. But the most direct way, the old-fashioned way, is give us a call.
Sounds good. And then do you do?
And I'm an old-fashioned guy.
Sounds good.
I've been around for a while.
And then do you do anything like a free? Like if someone calls you, do you do like a free consultation or anything like that, or how does it work?
That's good. I offer 2 free consultations.
Oh, awesome.
And the first one is basically for us to get to know each other, and I find that the first meeting gives the client a chance to see if we are the type of firm that can help them. Mm-hmm. So they're able to kick our tires, let's say, and get an idea of what we do. And then I'm also able to see what the client is looking for and if I can help them. Mm-hmm. So at the end of the meeting, we typically are in a position, one or the other, to say, yes, it's a good idea, or no, you know what, I don't think it's a good fit. And then if we do find that there is a good fit, then we'll go to the second meeting and really get into the details of the client and find out, more details of what they're worth, what their goals are, what they do for a living, their family, so on and so forth. But the first meeting is really, a high level, let's talk about you, what are your concerns, and then I can give you an idea if I can help you or not. And again, the client can see if what we offer is what they're looking for. Mm-hmm. So it's 2 free initial meetings.
That's great.
And by the end of that point, I think we're able to say let's move on and work together, or it doesn't make sense.
That sounds good. Yeah, I like that, because I mean, someone might say, I'm already paying my accountant, and why do I have to hire another professional and now pay even more money? Is it worth it? What if it's not? So that's great actually, how you have the 2 just to make sure. And then there's no risk that way. Yeah.
That's right. Exactly. And people are allowed to say no.
Right.
Like usually there's lots of pressure when it comes to when you're dealing with a financial advisor in general. They're also salesy, and they're looking. The more sales they make, the more money they make. So our industry is generally a salesy industry. Okay.
Right.
I've tried to eliminate that from my practice. But what I'll say, you mentioned about the accountant. One thing I tell clients off the top: we're not there to replace your accountant. I want to meet your accountant, and I want to talk about your situation with your accountant. I'm not going to say let's lose this accountant unless the accountant is terrible, and then we'd find them another accountant. But we're not there to replace the accountant. We're there to complement them. Mm. And once accountants realize that, they're not defensive. I mean. So we're not charging, when we're doing tax planning, estate planning, we're not charging any extra fees for that. That all comes with the initial fee that is being paid to manage the client's money. Mm-hmm. And generally speaking, the client ends up paying about half the amount of fees that they were paying their banks, and they're getting a heck of a lot more service and more real financial planning, or more comprehensive financial planning. Mm-hmm. And the fees, when you're dealing with an independent financial planner, the fees are also tax deductible, which is not the case when you're purchasing mutual funds through your bank, for example.
Right. That's great. That's wonderful. And then you work with Canadians all over Canada, I assume?
That's right. Okay. I mean, I've done, phone call consultations and what have you. Generally, it's interesting to be meeting a client face to face. So and most people enjoy that or would prefer that. So if ever any one of your listeners needs a financial planner, an independent financial planner across the country, I'll be able to help them, and I'll be able to sort of take them to, or show them people in their area that they should be working with. I'm in the Quebec area, the Montreal area. So, but I've worked with clients out of Ottawa, for example, and there's a few clients, as I've mentioned, that truly believe what I have to say, and we usually do conference calls or we're on the computer and we're talking face to face like that.
That's great. That sounds good. Yeah, because I get questions like that from listeners of the show sometimes. They're looking for someone that has sort of that business background, because they might have their own business as well, and so they want they know that there's certain things you can take advantage of when you have your own business, but that's an area where you really want someone specialized in, like in your case, right? So that's great. So yeah, I'll if anyone's in that area, I'll refer them to you, and even if they're not, like you said, you can work with people remotely as well, and that's not an issue. So that's fantastic. So that's good. I'm happy I have a person to refer show listeners to when they're asking for a planner that has kind of a specialty in in terms of businesses, and tax optimization from that perspective as well.
Right on.
So
right.
Awesome. That's awesome, John. I mean, I don't know about you, but I had a really, really good time chatting with you, and like I said, I can sleep better at night knowing that you also kind of have the same views as myself. After even more years in this industry than myself. So yeah, I mean, it's been great chatting with you. Like I said, I'll have in the show notes, I'll have all your information as well, and that's it. That's it on my end.
Right on. I enjoyed it too, Cornell. I'm just looking at the clock here, and I can't believe it's been over an hour. Right. Time flies when you're having fun.
That's right.
Oh, when you're talking about something that you're really passionate about, time flies.
Exactly, for sure. Okay, that's awesome, John. So yeah, have a good one. Thanks for coming on. I'll have all the links, on my page, so the listeners can check you out as well, ask you any questions, things like that. And yeah, have a great week, and I'm sure we'll chat in the near future as well.
I appreciate it, Cornell, and good luck to all your listeners, and we'll do this again.
Awesome. Thanks, John. Have a good one.
Thanks to you. Bye-bye.
All right. I hope you enjoyed the interview. You can get all the links in the show notes at buildwealthcanada.ca/30. Of course, if you're interested in index investing, don't forget to check out my full step-by-step video guide over at buildwealthcanada.ca/invest. Or if you're more of a dividend investor or just like to pick your own stocks, then you can get some top quality free help from 5i Research by getting full access to all their stock analysis reports, their model portfolios, and over 47,000 answered investing questions by signing up for the free trial, which will give you unlimited access to everything for 30 days. You can get all of that by going to buildwealthcanada.ca/trial. All right. Have a good one, and I'll talk to you soon. Take care. Bye.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.